Then their total public debt soared to 259% of GDP. That is the reason the public debt of developed countries such as the US soared and exceeded 100% of GDP. In 2019, the former IMF chief economist Olivier Blanchard proposed an entirely new financial model. Welcome to the Coin Post. The US debt is approaching $27 trillion, and as Robert Kiyosaki points out, the main problem is not the pandemic, but an unbelievable amount of debt. The US is bankrupt.
Oh, déjà vu.
You're right, we already talked about Robert Kiyosaki's thoughts on this. But then, it was about the best opportunity to buy gold, silver, and Bitcoin. And today I propose to look at whether such a huge national debt could actually lead to a US collapse, and eventually the collapse of the global economy. Get ready to compare different government debts, and also subscribe to our channel and join the best community on YouTube. Let's start. State borrowing dates back to the Napoleonic Wars. By the way, Britain's public debt was 164% of GDP in 1815. And the interesting thing is, the country did manage to cope with that. Then there was World War II, and misty Albion was forced to borrow even more money. Then their total public debt soared to 259% of GDP. Once again, the threat passed, and thanks to the right government policy and probably no major wars, by the year of 2000, the United Kingdom had a debt of about 40% of GDP, and as of today, it's up to 70%, fueled by the 2008 crisis and the 2020 corona. As we can see from this example, public debt alone doesn't necessarily lead to collapse, even if it reaches such horrific levels as 259%. Does this mean that the US is now safe, and its $27 trillion debt is just some kind of boogeyman for gullible people? Well, it's a double-edged sword, really. To explain it, let us first address why states suddenly increased the borrowing so dramatically. And I know it's the COVID-19 and stuff, but it's not a war. Knock on wood. Countries used to be terrified of increasing public debt, but they still did so because of various economic problems, such as the 2008 crisis, for instance. The principal instrument for borrowing is bonds, which can be called a payment receipt with a certain percentage. The government issues them and sells them on the securities market, and investors, both private and institutional, like various companies, hedge funds, pension funds, and even central banks, buy them. By the way, most of the US debt is in the hands of China and Japan. Even though bonds yield less than stocks, it's still a pretty reliable instrument. And everyone knows that the government would do whatever it takes to pay off debts. If of course we're talking about the US government, not Argentina, which has gone through 8 or 9 defaults or so. In that case, one more or less makes no difference. But if you buy US Treasury bills, you can be 99 and many nines after a comma % sure you get the payout. And this very certainly is fundamental to the securities market. That is, holding money in US bonds, you can sell it at any time and get cash if needed. That is why these assets continue to be called defensive, even though recent returns have been extremely low. The 2008 crisis was a turning point because governments realized that one way to fight a recession is by stimulating it and making money injections. That is the reason the public debt of developed countries such as the US soared and exceeded 100% of GDP, and developing countries increased the borrowing rates to an average of 35%. You may ask, why such a difference? The answer is that the less trust a particular government has, the fewer people are willing to lend to it. On the other hand, the smaller a country's economy, the less it needs to be supported and accelerated. Overall, the country successfully managed the 2008 crisis. Well, you, my dear viewer, can say, tell that to the people who got in trouble with currency mortgages because of the national currency devaluation. By the way, share your opinion on this. Let's chat. But in fact, we're dealing with a situation where the fire in the economy was put off just by using a huge amount of cash. And analyzing this experience, in 2019, the former IMF chief economist Olivier Blanchard proposed an entirely new financial model. He argues that states can borrow as much money at very low interest rates as they want, provided that their economies grow at a high rate and that a country can pay off its current debt obligations easily. Calculations totally support this new paradigm. I mean, if your income grows faster than your spending, then the total amount of debt doesn't matter much. But can it work at the state level? We'll talk about it next. Now I'm gonna ask for help in fulfilling the milestone of 10k subscribers by the end of the year. I want more of you beautiful people here, and I'm sure you want more of those cool videos too. So, what we mentioned earlier vividly shows that the rise in public debt beyond the 100% mark of GDP doesn't mean a default, and there have been similar examples. Moreover, today's extreme surge in borrowing to deal with the critical economic situations is considered normal, and not only in the US but other countries too. Nevertheless, we must realize that it's quite a risky approach. After all, if a country makes a mistake in allocating the borrowed funds, it won't lead to economic growth. For example, the Fed is now actively printing dollars, but the money is flowing right past the real sector and into the stock market. And they will continue to do so for the whole 2021, keeping the zero interest rates. Equity owners are getting richer, enjoying their lives, and not thinking that inflation is still below target, which means the economy is in recession. And if you look at Europe, Germany and Italy, they still had a slide of 0.1%, but still deflation this summer. That is, the economy is falling apart, GDP is not growing, and the only thing we hope for is that these processes will soon be reversed, that 2021 will bring huge profits, and that the countries will be able to pay off the debts they have accumulated. In fact, we're left to sink or swim, and the bigger the debt to GDP ratio, the bigger the interest rate is. And so for now, Robert Kiyosaki, and not just him, will continue to be frightened by the massive built-up debt. What I suggest doing is looking at the real state of the economy, that is, whether we can service the current debt level and how the income relates to the current expenditures of countries. This is important because if it doesn't work out with cheap money and the economy does not restart, then the March stock rush will seem to investors to be a simple misunderstanding compared to what would happen to stock price if the world economy collapsed. Help YouTube prove that this video is worth showing as many people as possible by clicking the thumbs up and sharing it with your friends and family on social media and messengers. What if they read Kiyosaki's tweet and now they're panicking what to do next? And that's it for today. Thanks for watching. It's the Coin Post channel. Subscribe and get enlightened.